Good morning and welcome to the Killik & Co market update. At the moment, it's the second quarter reporting season, and so far we've seen some very strong results from companies involved in cloud computing. Now I'll talk you through some of those numbers, but first of all I'll just touch on what we mean when we talk about cloud computing. So several years ago, before the days of cloud, most companies would have their own servers on their own premises where they would store their data, and the companies would be responsible for keeping that data secure and for making sure they had enough capacity. Nowadays, it's more likely that these companies will save their data on the servers of a cloud provider, for example a Microsoft or an Amazon, and the companies will access that data via the internet, and that's what's known as cloud computing. And it then becomes the responsibility of the cloud provider to take care of security and to make sure there's enough capacity. And it becomes cheaper because of economies of scale, and it's also much more efficient because the companies only pay for the capacity that they're actually using, and if the companies need more capacity on short notice, that's available to them within minutes. So you can see why cloud computing is becoming more and more popular. So let's have a look at how quickly this industry has been growing. And we've got these numbers here from Gartner. And as you can see, the global expenditure on overall cloud computing has been rising steadily over the last few years, and they expect that by the year 2020, the total global expenditure on cloud computing will be over $400 billion. And that expenditure is broken down into a number of different parts. So as you can see, cloud advertising accounts for a very large proportion. You've then got cloud infrastructure services, so that's just supplying the basic data storage, and then you've got things like security services, so lots of different ways in which companies can make money from cloud computing. So let's have a look at some of the companies involved in cloud computing and the type of revenue growth they've been achieving recently. So first of all, Amazon, they're the owner of Amazon Web Services. They haven't reported yet for the second quarter, but in the first quarter, they reported growth in revenue from cloud services of 49% versus the same quarter a year prior to that. So a very high rate of growth there. Then IBM, they've already reported for the second quarter. They've reported a 26% growth rate. And then Microsoft, they reported yesterday for the second quarter, and they've reported a growth rate from cloud services of 89%, so a very high growth rate indeed. But it's important to recognize that these companies are not all doing the same thing. For example, Amazon and Microsoft are perhaps more focused on the infrastructure, whereas IBM offers a blend of both infrastructure and services. So all these companies operate in slightly different ways, but all are achieving very significant revenue growth from cloud. Now, why has Microsoft got such a high growth rate in comparison to the others? Well, one possible reason is that Microsoft has had fantastic relationships with many other businesses because they've all been using Windows for so many years or even decades. So now that cloud is becoming more popular, it's quite straightforward for Microsoft to cross-sell its cloud offerings to all of its customers. So that's perhaps one reason why their growth rate is so high. And all this growth in cloud-based revenue is feeding into the race to become the world's first trillion-dollar company. So here you've got the top three contenders. As you can see, Apple is still ahead. They've been ahead for quite some time. They've got a market cap of $934 billion. But as you can see, Amazon and Microsoft have been closing the gap recently. So Amazon's at 894, Microsoft at 808, and it's not inconceivable that one of those could get there first. Now, a few weeks ago, we talked about the fact that Unilever is moving its headquarters from the UK to the Netherlands. And that will probably mean that Unilever will have to come out of the FTSE 100 because it's purely a UK-focused index. And in the last week, we've seen quite a lot of protest from Unilever shareholders about this. And the reason they're so annoyed is that a lot of Unilever shares are held in passive funds and ETFs that simply track the FTSE 100. So if Unilever comes out, it means that all of those passive funds will have to sell their Unilever shares. And the shareholders are worried that that could have a detrimental impact on the share price. And for me, that just raises the idea that so much of the market is now held within these passive funds and ETFs. And I've been looking at the last PwC reports on the global asset management industry, and they think that in 2016, passive funds, including ETFs, accounted for 70% of the overall market, and by 2025, they expect that to rise to over 25%, so a very significant proportion there indeed. and they think that by 2025, the total assets under management within passive funds and ETFs will be over $36 trillion. So a huge number there. And it does beg the question, is it right that so much of the market should be in these passive strategies? And last of all, the implied probability of a UK interest rate rise happening in August is now 82%. So it's a very high probability, and it's thought that some very negative data would have to come out between now and then for that rate rise to not happen. So that's definitely something to keep an eye on. Now, moving on to the week ahead, as I said, it's the second quarter reporting season, so lots and lots of companies are releasing their results. But next week is a particularly big one for oil and technology. So next week we've got results coming out from Total and Royal Dutch Shell, and also Facebook, Alphabet, Amazon and PayPal. That's it from us. Have a great weekend, and we'll see you next Friday.